Good morning and welcome. My name is Teresa Campbell. You have joined the Printing Industry Midwest and PIA Mid-America Financial Executives Council CEO panel and discussion on mergers and acquisitions. Note that all of our attendees are placed in mute mode during the session to ensure a quality, which will be made available you to comment and ask questions during the program by typing into the Q&A field at the bottom of your screen, and we ask that you communicate technical difficulties in the chat field. We'll separate those out and we will ask the Q&A questions when it's most appropriate. If it's specific to that slide, if it's something we know that they're going to cover later, we may hold that question, and then of course we'll have some open time at the end for any additional Q&A. So you should know that the Financial Executives Council is coordinated by leaders in both the North Central and South Central regions. They guide the programs and content offered with programs 6 times a year. The focus is really around financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Carl Nathy with Myers Printing, Ken Rain with Daily Printing, Ryan Wagner with Action Mailing and Printing, Matt Wills and Rick Griesgraf with LB Carlson. And I'm going to ask that Ken Rain take over and start with an introduction of our panelists.
Thank you very much, Teresa. And I'd like to welcome everybody to our webinar today. As Teresa mentioned, we do meet bi-monthly, and we love to have people send us comments and questions through that Q&A area. And also, if you have any ideas of topics you want in the future, please chat that too, so that we can guide this towards what our members really want. I have the honor of introducing our 4 panelists today. We have Dawn Polfliet and Mel Enger from LB Transitions. They'll be kicking off this webinar. We also have Todd Williams, who is the president and CEO of Fidelity Bank, located in Edina, Minnesota. And then finishing out our group panel today is John Farnsworth, who's a partner at Spencer Fane. With that being said, let's dive right into it. We have a lot of content to offer. So I'm going to turn it over to Mel and Dawn.
Thank you, Ken. Appreciate the introduction, and thank you all for attending. It's good to see a great turnout here, and I just had a few opening remarks and comments, and this is our agenda, as everybody can see. Ben, if you could just get to the next slide. Yeah, so why is this a pertinent topic? Well, M&A is really always a pertinent topic, in my opinion. I guess it's the landscape always changes, and like everything else, sometimes it's more active than other times. Right now, I still see it as a pretty active market, but M&A will never go away. That's why it's very pertinent, and I assume that for you attending, it has some relevance, and that's why you're here, to get some feedback. And we'll do our best to hit on a lot of different topics today. And even if it's not of interest today, I do feel like M&A at some point for many business owners will be a consideration. So it's always good to stay up to date on what's happening out there. Our objectives for the presentation, I would say it's pretty high level discussion. I know you might be tuning in to hear specific things. We may or may not cover those, but we have a limited time here and a lot to go through. So just real quickly, Dawn and I are going to go over some market trends that we're seeing in the M&A field. We're going to also cover, from our perspective, what a typical M&A process looks like and what you can expect from that. And also, we're going to specifically talk about company valuations because of the importance of that. Todd from Fidelity is going to be covering the banking and financing perspective, which I'm sure we're all anxious to hear about as things have been changing out there. And then John will be covering legal considerations with respect to M&A transactions. So with that, I'm going to kick it back to my partner, Don, who's going to talk a little bit about some market trends.
Okay, thanks, Mel. Ben, go ahead and go to the next slide. We're going to start here with some high-level market trends. And this is an overview, not just of printing, but of all sectors. And you can see here is a 20-year M&A history. The blue lines represent number of deals that have occurred over that 20-year period. And it was pretty ranging right around the 10,000 to 12,000 deals until you got to the 2008 financial crisis, then a little bit of a dip there. Then also moving along, increasing slightly, down a little bit in 2020 for COVID, but then you see in 21 a significant spike, up 49% from the prior year. And now in 2022, coming back down to probably more normal levels. And then we see in 2023 also some additional decline. This data, just to let you know, is from FactSet Review. They've been tracking this for more than 50 years. Didn't think I had to go back quite that far though. Let's go to the next slide. So this slide represents from March of 22 through June of 23, so pretty current data, what is happening on a monthly basis for number of deals, so deal volume. And again, you see the trend for that whole period trending down. In particular, I think it's interesting if you compare June of 22 to June of 23, pretty significant decline during that period. The blue line that kind of jumps around throughout the graph represents total deal value. That's in billions. So I should say all this data too is from publicly announced deals. So there are obviously more deals that aren't publicly announced, but these charts represent those deals that have been announced. Let's go to the next slide. I thought this was kind of interesting. It compares the last 3 months ending June 30 of 23 to the last 3 months of June 22 by sectors. You can see which sectors had the biggest decline, comparing those two periods. You go down to toward the bottom of that chart, you see, technology, commercial services, finance, all with some pretty significant decline in the number of deals completed. We're hearing, and we'll hear more about this throughout this webinar, economic recession concerns, interest rate concerns. Both those things are having impact, I think, on the number of deals. Having said all that, we're still seeing a lot of buyers and sellers, just not the record number that you saw in 2021, but we are still seeing a lot of activity. Let's go to the next slide. This slide is showing you by sector what are EBITDA multiples doing. So the comparison here, the gray bars are all time periods to the last 12 months. And hopefully you can see this, not too small. But if you look at the manufacturing one, kind of towards the left, all periods were at 6.1 for an EBITDA multiple. Last 12 months, 4.4. And almost all of the industries here have experienced a decline, with the exception of those two spikes in the middle. Those represent information technology and finance and insurance. Pretty significant multiples in those two areas, and also increasing. Next slide. So this is just another way to look at the EBITDA multiples. This shows quarterly comparisons, starting with second quarter of 21, and this is a median value EBITDA multiple for all sectors. Pretty consistent between 8 and 10 until the last second quarter of 23, significant decline there. And I just kind of want to remind you what we just talked about, heavily impacted by technology and finance. You know, those multiples are quite high, but if you remember, they also experienced the largest decline in number of deals completed. So I think that is having quite a large impact on that 4 multiple you're seeing. Next slide. So this chart shows you EBITDA multiples by net sales. I think this is interesting to look at. If you look at that top line, that represents companies with revenues greater than 10 million. You can see their multiples between 9 and 13 over this period of 10 years plus. And as companies are smaller in terms of revenue, in general, the multiples are less. And why is this? Buyers look at it as from a risk profile perspective. Often larger companies have more sophisticated systems, more personnel, maybe less of a customer concentration. There's just a number of things that are reflected in the risk profile there that lead to that higher multiple. Next chart. So what about the print industry? Well, as you probably know, it's a really wide range. Mel and I work in this area all the time, and we've recently seen anywhere from 3.5 to 12. And that's a big range. I know there is some downward pressure, but still some really healthy multiples being paid in certain markets. So if you're packaging, complex labels, certain areas, you're still seeing the high end of that range. We also subscribe to a database called Deal Stats, and they accumulate data from private and public company transactions that have been completed. And it's a database with more than, I think, up to 47,000 transactions now. So I did a search before this webinar just to do a comparison for the print industry. And they track mostly smaller transactions between 1 and 10 million. So that's where you get the best population. So I pulled the 10-year median for EBITDA multiples. That was 4.3. And that's a median for all types of printers in that size range. And then compared that to, well, what is it for just the last 18 months? And that was 3.4. So down kind of as expected and following the same trend. So what else impacts these multiples? Obviously, cash flow and size are key factors, but I've listed here some other really key things that can impact the multiple. The first one, premium niche, unique products, specialized process. If you have something that's really complex, regulated, there's a higher barrier to entry for your competitors, and it makes your customers really sticky, and buyers recognize this and they'll pay a premium for it. So that's really key. Probably that first one impacts multiples as much as any of these. Revenue and earnings growth or lack thereof. Buyers are looking for growth. Current technology, faster. We know it's ever changing, but if you're more efficient, higher multiple. Account concentration, that's a big one as well. We frequently hear if it's 20% or more that there's a concern. This is an area that's always looked at hard by buyers. PE firms in particular, if you reach a certain concentration level, many of them will no longer have an interest. So that's something to be aware of. Union status. This can be a benefit for some, but it can also limit the buyer pool. Key employees, special skill set. Buyers are always looking for key employees, always interested in the skilled workforce. And then EBITDA margins. We encourage our clients to track EBITDA with a goal of exceeding 10%. And if you can even get that higher, 15 to 20%, you're likely in a position to receive a premium on the multiple. And then revenue in excess of 10 million, we just saw that chart previously where how the size impacts multiples. So if you decide you're thinking about selling and wonder how long is it going to take, this is a chart that shows over 5 years pretty consistently that it's 200 plus days to sell. One thing to note here is this chart represents from listing date to close date. So once you actually go to market and list, it's about 7 months. As Mel's going to talk about next, there's probably 45 to 60 days or more on the front end to prepare and to make sure you have everything put together in a good package and you're well prepared to go to market. So it's really probably more like 9 months from the start. With that, Mel, I'll toss it back to you.
Quickly, Don, quick question, and that is with the multiples scaling down, would you say that it's becoming more of a buyer's market?
There's definitely more ability for the buyer to negotiate, right? So maybe headed slightly that way, although there's still a lot of parties on both sides.
Okay, thanks, Don. Yeah, I'm going to dive into a little bit of the M&A process here. I thought it would be good, at least from our perspective and what Don and I go through on a regular basis, just to give people a expectation if they want to start going down this path. I broke it down into really 2 buckets here. One I call the pre-process stage, and this is really before your decision to sell or buy. Now, we're primarily going to talk about from the seller's standpoint here, so keep that in mind. And so I'm really talking about an ownership transition. And again, this is pre-process before the decision is made. I mentioned succession planning here. It's something I always like to talk about. It doesn't necessarily mean M&A is your plan, but I just want to remind all owners that they should be talking about this and thinking about this on a periodic basis, even if it seems years away, because you just never know when something's going to happen unexpectedly, and you might have to do something with your business or your plans change. It's always good to know. I like to think about it as how you want to get out and when you want to get out. We have a lot, well, from time to time, we have clients come to us and just say, you know what, I think I'm ready. Let's go to market, find me a buyer. And we like to, this could come from a bad day they had or a bad year they had, and they're just reacting to it. And we like to slow them down a little bit. And in this pre-process, talk about the reasons why they want to sell or get out. Making sure you're really ready and really committed to the process. You can sometimes tell that people are on the fence, even though they're saying one thing. It's a very emotional decision for many owners to make the decision to sell their company. And so we like to spend a lot of time talking about the pros and the cons and expectations of the process. For most business owners, they've never been through a transaction before, and they really don't know what it's all going to take. And there's always more to it than you think. And of course, talking about the options. Ben, next slide. Just real quickly, this is part of the conversation we like to have, right? I mean, one option is to just do nothing. We like to remind people that is an option. If you don't want to pursue anything for now, just don't do anything. Liquidation, never a great option, but it is an option. Sometimes, unfortunately, people are forced into that place, but it's still an option. Family transition, if there's family involved. Management transition, I don't have it listed here, but ESOPs are an option. a true merger. And, you know, generally, I shouldn't say generally, but oftentimes it ends up that their plan is going to be an outside buyer. So next slide, Ben. Okay, so getting into the actual process, right? Now you've made the decision to sell or buy. Again, we're going to be talking about sellers here specifically. And you are committed. You're saying, yep, I'm ready. We've explored all those other things. I want to go to market and sell to an outside party. We've explored internally, but we're going to go to the outside. So as Don mentioned, average timeline to closing 9 months. Don mentioned 7 months, but that's from listing date. I always like to remind people shortcuts can be expensive, because you might think 9 months, that's a long time. Why does it take that long? And well, people who do shortcut the process probably are going to be leaving something on the table. So we just encourage them to go through it the right way. You get to sell your business generally once, and so do it right. So what are some of these steps to think about and from an expectation standpoint? So before you actually go to market, we like to say, and this is just based on our experience, it's about 2 months from the time I'll say we're engaged or the decision is made. And why is that? Well, there's a few things. Well, there's many things. The three primary things are building what we call an informational packet, a SIM. This is a very detailed, comprehensive overview of your company. It talks about your history, your background, key people or positions. We don't name names. We don't name customer names, but you're providing customer information, financial statements, equipment capabilities, and so forth. It's what I like to say is it's when we finally get engaged with people and they're interested and they sign an NDA, they expect this right away. And if you're scrambling to pull it together, you're going to lose a lot of credibility. We like to have this ready to go and have it look very professional. We develop a prospect or target list. What that means is it's usually a combination of specific companies we're going to approach that we know are really good fits and strategic targets. And then there's more of a blanket list of industry contacts throughout the country. And if you're large enough or have a special niche, it could be the private equity market as well. So we're developing that list that when we're ready to go to market, we're contacting all these parties immediately on day one. And the third thing that's very important in this process is to build a very good, supportable valuation for a lot of obvious reasons. And at this point, I wanted to go back, turn it back to Dawn. Dawn is certified in business valuations, and she has done many in the printing industry. And Dawn, take it away.
Okay, thanks. Yeah, I've been doing valuations for more than 15 years and have done a lot in the graphic arts industry. So yeah, we do think this is a really important part of the process. We sometimes find that business owners really don't know what their business is worth. So it's a good place to start for planning, for setting expectations, helping the business owner understand what drives value, what are those value drivers, and maybe what can be done to enhance value. So in any M&A deal, we spend a lot of time digging in and really understanding and helping the owner to understand what the business is worth and what's driving that value. Once you have the valuation, it also helps when you start getting offers, helps with the negotiations, kind of sets a baseline so you can evaluate the offer and, is it good? Is it bad? Is it exceptional? Gives you something to compare to. And there's a lot of challenges as you go through the negotiations to EBITDA and to the multiple. And if you've done your homework really well up front and built really good detailed support, you tend to do better during that negotiation process. So we don't shortcut. We spend a lot of time and have all the support, and we think it's definitely worth the time that's invested. The other area that it's helpful for is with tax structure. And sometimes this is an afterthought, and it shouldn't be, because it can have a big impact. And it's also potentially a negotiated area. Both parties always want to maximize their tax benefits, and they have competing interests. Buyers want to buy assets, and sellers want to sell stock. Usually buyers win that argument, but there are things you can do with the purchase price allocation to help maximize tax benefits. So it's an important thing not to overlook and to not shortcut, and to do it early in the process. Okay, next slide. So how's value determined? Typically based on expected future cash flow. And this is assuming an ongoing operating profitable company. We're not talking about a liquidation scenario, but in an ongoing operating company, we look at expected future cash flow, because that's what a buyer's most interested in. What is the future cash flow if I buy this company that I'll be able to receive from the company? Typically measured as EBITDA, and we've talked about EBITDA multiples some already. So part of our process is to really dig in then and look at historical, usually 3 to 5 years of financial statements. Also look at a financial forecast. I put here well-reasoned. Another word for that, I guess, would be believable, obtainable. I mean, a good forecast. Because as you go through this process, time will also be passing and you'll be measured against the forecast. So it's good to have a good forecast in place. So we'll ask a lot of questions. We'll evaluate trends. We'll look at variances, growth, volatility, and do a comprehensive analysis of what is the expected EBITDA, and use that for the valuation. Next slide. So we're looking at earnings. We do a process called income normalization. Normalization is really identifying anything that's unusual, non-recurring, maybe discretionary. I put here extraordinary, non-GAAP. I listed a few items here that are common, and it is very common. I would say almost expected that there would be some adjustments to the EBITDA that you've reported on your financials. As long as they're supported and well documented, it's not unusual to have adjustments. So let's just talk about a couple of these. Market rent is really important to look at to make sure it's at market rates. A lot of the companies we deal with, they have a related party lease, and rent may be higher or lower than market rates for cash flow or tax. I mean, there's lots of reasons why that might be the case. But for valuation purposes, you want to make sure that you've looked at it and set it to market rent rates so that you're not, for instance, if you were paying higher than market rent, that's bringing down the earnings of the company, and you don't want to undervalue the company, because chances are once you sell the company, you'll no longer be able to obtain the higher than market rent from an unrelated party. And along similar lines, we look at owner comp, make sure that's at market rates. The PIM salary survey is a really great resource for that. COVID impacts. This is getting to be less and less. Most buyers are focusing on current periods and really kind of excluding 2020 from the analysis. But there still are some credits, PPP or ERC, that may be coming in more current periods, so we want to normalize for that. And professional fees, travel and entertainment, anything that's unusual or discretionary, maybe litigation, settlement, something that is non-recurring, we'd want to normalize. The idea is that you want to remove any of those items from the historical financials to try to provide the best indication of expected future cash flow. And then this is what we're relying on as part of that EBITDA analysis for the negotiations and the ultimate purchase price.
Thanks, Don.
Yeah, thank you, Mel.
Yeah, so I just wanted to continue on now with the process. So we've done all this preliminary work and we're ready to go to market. It's usually a pretty exciting day, nervous day as well, because you just don't know what the reaction is going to be out there. So what happens next in this process? And it's all about expectations here. Hopefully there's a lot of interest, right? We typically, when we start to market a company, it's usually, we usually do it on a 4 to 6 week period. That's just an average. And that first week, first 2 weeks, maybe there's a lot of interest, and then it starts to weed off after that. But we're out there for 4 to 6 weeks. And what's happening during these 4 to 6 weeks? Generally, there's a lot of stuff going on with Don and myself and these prospects in terms of executing NDAs that go back and forth, sending out packets. We're fielding a lot of inquiries and questions and requests for more information. Sometimes it may lead to some meetings with owners if we think it's appropriate. But the objective here is during this time, we're hopefully weeding out some prospects that aren't worthy or we just don't think are a good fit, and trying to focus on the ones that are going to produce an offer, right? I mean, that's the idea here. So we get a good feel for who those are, and discussions continue. This is a point where there's a lot of negotiations going on. And I'd even say some preliminary due diligence, because if people are going to make an offer, they may or may probably want more information. We're building up to an executed LOI. That's the goal. It's a non-binding document, but in our opinion, a very, very important document, because this lays out the agreement on the primary terms and conditions of the deal. So a lot of time and care is spent getting to this point, but now you are exclusive, which means we have to stop marketing the company. We can no longer talk about this with other prospects. And as a matter of fact, the owners of the business are not allowed to either. Ben, next slide. Once we have that executed LOI, we're into full due diligence. And I just want to pause here a moment and just talk about this from an expectation standpoint, because this is an area where it can be frustrating. It can be, you might feel defensive at times because these buyers are basically turning over every rock, and it's almost like they're looking for a reason not to buy the company, which they're not, but they're making sure that the offer they made is justified, it's valid. And so you have to control not being defensive and not getting frustrated, but they can dig into a lot of areas: financial, legal, environmental, IT. If it's a private equity firm, quality of earnings reports, which are very, very comprehensive. So this is an area too where I always recommend sellers to be prepared in advance as much as you can, right? And we would be doing this earlier in the process. I didn't mention it, but I am now, is that we know what to expect in this area. So we like to have these, as many things as we can have ready. We'll have them readily available in a data room. And so when people start to ask for things, we won't have to say, we'll go back and do that and pull them together. They're ready to go. So very important area here. During this time, also the definitive documents are being drafted and they're going back and forth. And this is, John's area, which he'll be talking later. So I'll leave that to him. But I also mentioned closing and post-closing, just something to think about here. I think sometimes people think, well, we got through the documents and due diligence, so all we got to do is sign and get our money. But you got to start thinking about closing. And communication with your employees. How are you going to do that? And your customers and your vendors. So there's a lot of thought that goes into the messaging and the timing, and post-closing matters as well. I mean, it's not done just because you've closed. There's always things that have to be buttoned up afterwards.
Can you talk, or I'm sorry, Mel, you talk about full due diligence in a lot of areas here. Can you elaborate on how equipment value plays into the picture, particularly if it's newer, viable, or specialty equipment?
Yeah, I can. Yeah, that's another area that would be looked at. We've had people come out that are equipment experts to look over a company's equipment just to make sure it's what kind of condition it is, how old it is, and it factors into the valuation process too. If people think that, well, they haven't kept up to speed here, they haven't put the capital into the company year after year, and we're going to have to do that post-closing. Yeah, that is a good point, Teresa, that they will look at the equipment and determine if there's an adjustment to the purchase price if they feel it's not being kept up adequately. And it could be vice versa too, if it's very state-of-the-art equipment. Yeah, so just to wrap things up here, we've talked mainly about sellers, but buyers, you might be buyers that are I generally put buyers into 3 categories, and that's most owners are not buyers and will never buy another business. Then I have the casual buyers that may react to opportunities that come across their desk. And then there's the proactive buyers. These are ones that have a specific initiative in mind, and they've engaged or assigned someone to carry out this initiative. And next slide, Ben. Just because I'm going to go through this quick because I'm looking at the clock. So there are steps in this process too. This is the short version, I call it. But, again, kind of the pre-planning stage, we want to know what you're looking for. Is it volume, capacity, diversification, location, and so forth? So we can go from there and target opportunities to research. A few other things to mention here. If you're a buyer, financial feasibility. What does that mean? Well, what can you afford to buy? And running some models out so that you can see, I like to call them what if scenarios. If we bought this company, what is it going to do to our business? Am I going to get the ROI that I deserve for taking this much risk? Owning a business, buying a business is very risky. And if my model says I'm getting a 5% return, to me, my opinion, that's not worth the risk. You are probably paying too much if that's your expected return. And then, of course, we go out and connect with these targeted prospects. One note here, if you're a proactive buyer and you start knocking on doors, and I'm sure people get flyers all the time, is your business for sale? Most businesses are not for sale, but a lot of companies will talk because you never know, right? If someone's going to write a big enough check, they might sell. So the point here is, if you're in that mode, you may be ending up paying a premium for a business. Okay, last slide for me, just to wrap this up. Not everybody is a buyer, but at some point, all owners will exit their business. That's just a fact, right? And oftentimes selling is the answer. So again, a reminder about succession planning, and to keep that in mind throughout your ownership. It's never too early to start thinking about that and what your options are. And one last point, if you're thinking about a sale in the near future, like if you think you're 1 to 2 years out that you'd like to have your business sold, I would say get started right away. There's a lot to do. And if you want it sold in 1 to 2 years, I just mentioned all the homework, get going on it. If you're thinking 3 to 5 years, start the process. I don't think you have to dive too deep, but I would certainly focus on the valuation part of it that Don talked about. So that is it for my part, and I'll turn it over to Todd from Fidelity Bank.
Thanks, Mel. Well, hey, just a little bit about myself. I'm the president here at Fidelity. We're located up in Edina, Minnesota, in the Minneapolis area. I've been in banking over 35 years, primarily in the commercial lending and group. And I've really had the bank, as well as myself, focus in on business owners and mid to small businesses. And generally, I would classify that with revenues 100 million and below, but primarily probably 50 million and below. So next slide. You know, one thing, there has been a lot of change here in the environment, especially in banking, which all makes sense. I mean, when you roll back the clock 3 years ago or 2 years ago, you could see just in all banks, there is a rise in liquidity and their balance sheets were expanding. A lot of that came through the government stimulus, through PPP and then now ERC. But all that, you could really see a big jump in the liquidity on our balance sheet. And then also, as I went to talk to a lot of our clients, you could see as they had supply chain issues and also just issues with just, you know, talent, you could feel the inflation starting to rise up here over the last couple of years. Well, obviously, the Fed saw that as well. And you can see, based upon the graphs here, I think it was a little over, I think it was maybe 15 months ago, I heard the word liftoff. And this liftoff in interest rates on the short term, as well as on mortgage interest rates, you can see in 2022, and as we're going in to 23, this is a historic elevation in interest rates as compared to history. So I think looking back a couple years, I think everybody expected interest rates to rise, but I don't think that they anticipated the velocity and the rate of raising interest rates. So that really kind of rolls us into probably what we've seen in the banking industry is when you have that kind of elevation in interest rates, now you've got cost of funds and interest rates that you're paying on deposits rising, but rising quicker than probably what you anticipated. But also, one thing that banks did with this excess liquidity is they used that to make loans. In a lot of cases, a lot of those loans are commercial real estate loans, or they went a little longer on bonds out a little bit further to get yield. And then obviously they've gotten caught. And so you can look at Silicon Valley Bank, but also a number of various banks, is when all of a sudden it gets out in the market that you may have some liquidity issues or some earnings issues or some write-downs on bonds. Then all of a sudden you have that liquidity issue, which you saw on SVB here back in March. Now, from our perspective, you know, it was an interesting time, but also when you look at a lot of banks, when you're coming into, let's say, M&A, a lot of banks have to really watch their liquidity, especially if they're involved in commercial real estate or they're underwater on their bonds. And so I think from a liquidity and lending perspective, there's certain banks in the market that may not be doing M&A lending or doing much lending because of the reasons we talked about earlier. There are banks, though, are probably in a better situation to ride this through and have that availability. So that's one component that really has changed over the last 2 years. Now, as far as anticipating a slowdown or recession, there isn't anything new. I think when you look at the leading economic indicators, here's a graph going back to 2000. Is one thing to point is as we look at our balance sheet and look at how we're lending, we're looking at these forward indicators of where the market's going to go, but they aren't perfect. And I think if you go back to 2022, when you look at the spikes, I think the Fed was increasing interest rates, trying to slow the economy. And then you can see as those leading indicators went down, obviously, if you hit a threshold here, we end up in a recession. So as you look here in 2022, that big drop was because of the pandemic. And then we had a huge decrease in interest rates and liquidity, which really showed the liquidity as well as the GDP growth. And now what you're seeing is that now it's going down. So as far as the industry that's hitting, we've already seen that in the mortgage industry or housing industry, primarily on people that used home equity loans for improvements to their homes. We've seen a little bit of a downdraft there. And then also just in consumers where they've used their lines of credit, now that's starting to get restricted a little bit. The one thing I think that has really surprised us as well as I think the Fed is inflation seems to be staying higher than they anticipated. And then also the consumers continue to spend. So even though we're seeing this downdraft in these indicators, GDP is still positive, and everybody's wondering when that's going to turn negative. And if I were sitting here, when I was sitting in this chair a year ago today, actually we thought we would be in a recession earlier, and we're just not seeing it. And so that's where you're seeing the Fed increasing and in tightening, and we'll go through that in a little bit. But also, I think banks are getting a little bit more restrictive in their underwriting of transactions, and that could be because of their own liquidity within the bank, but also what they're looking at is maybe future demand and GDP going forward. So, you know, we have seen a slowdown in M&A activity and then also multiples but it really depends on the industry. So that's that for that slide. Now, this is a sample transaction. Every transaction is different. I think Mel did a great job, as well as Dawn, is every transaction is different from a concentration, consistency of earnings. So this particular transaction is more around a manufacturing firm. And what you're going to find here is that on the left-hand side, you can look at the various components, but this was driven primarily from private equity on a structured deal. But in this particular case, on the right-hand side, I'm just going to walk you through on the third bullet is when we look at how much senior debt, and that includes sub-debt, generally we're looking at keeping that to 3.5 times EBITDA. And typically, if there's a sub-debt player, we'll look at their debt stack or their debt plus our senior debt. And in any case, we want to take an initial debt service or fixed coverage ratio initially on trailing 12 months of at least 1.35 to 1. So a lot of times, some banks will look at the line of credit and they would like to see a line of credit fully available for growth. And in turn, we're looking at some type of minimum working capital. On the left-hand side, the one thing that probably isn't obvious is that initial capital when you're coming to market is that you have to add to that the transaction costs, and that can vary based upon the complexity of the deal. And then finally, I think everybody's always interested in what type of pricing would you get on leverage. And this is going back to January of this year, but generally SOFR, which is the old LIBOR, plus 2.5 would probably be the lowest. And you would see that on the line of credit up to 3.5 over SOFR, which would probably be on the term debt. And we've gone generally between 5 and 7 years, and we'll swap that out to a fixed rate. So where is that today? I would say that that rate today on pricing on that term debt is, I'm going to ballpark it, it's probably 7.5%. I think probably earlier in the year, it was maybe a 0.5 point lower. So that's where we're seeing pricing right now on bank debt. Now, Mel also mentioned on our due diligence, we also like to see a quality of earnings report. And then generally we'll leverage or take the appraisal that the buyer is looking at and making sure that that's up to our standards. And then finally, we're always looking for those CPA reviews and audits, which Mel has been teeing up. So there's all kinds of various M&A or buyouts. So this again is just a general layout, but I think the thing to really look at is, hey, how much senior debt can you multiply against that EBITDA? And then also really looking, and we look very closely at the trailing 12 months of cash flow, even though you may have statements from the CPA or tax statements. We really want to look at the trend and extrapolate that information and move it forward. So that's that for bank financing. Now, one thing we try to pay attention to is, we try to model out for the bank is, well, where are short-term interest rates going? And one place we'll check is CMA Rate Watch. And so what this does is they take the information they get in the market and they say, what's the probability that where short-term interest rates will go? So today, if I had this graph as of today, there's a 99% chance there's going to be a 0.25 point increase in interest rates today. This, if you look at it, this is the probability on the next Fed meeting, is that there's a 60% chance that Fed funds will be at 5.25 to 5.5, and a chance, 30% chance that it'll be up at 5.5 to 5.75. So I think everybody that's reading the paper or listening to people, hey, they're anticipating 2 rate increases, and that's kind of where this graph is sending us. Now, what this does is obviously we're looking at additional cost of funds for the bank as well as our borrowers. But one thing you're going to find is there's an inverted yield curve right now. And so in some cases, our short-term funds are actually higher than in our long-term pricing. And so if somebody is paying a prime interest rate, that interest rate's at roughly 8.25, but we may be putting out long-term money at 5 years at right around 7%. Now, we'll have to see where things go. And the reason I'm bringing this up right now, if I looked at the same graph about a year ago, or excuse me, I think just a little over 7 months, this graph would have said that they anticipated that the economy would have slowed, and it was actually showing interest rates being at 4.25, not 5.25. So if you look at where the Fed was thinking things would be at this time, they thought we would be more in a downturn. Consumer spending would be less. And in some cases, we were anticipating rates to start moving lower. So I'm going to take you to the next slide. So now this is what this is telling us for a year from now at the next Fed meeting. If you look at the probabilities, this is telling us a year from now, short-term interest rates would be a point lower. So this would tell me that it's an indication of lower inflation and slower economic growth. Now, I told you this before, is I looked at these graphs, 6 or 7 months ago, and it was more in line with this. And then you look at where we're at today. So there's a lot of things that can happen that change this dynamic. But if you look at a lot of the recessions and a lot of the low interest rates that we experience in those leading indicators, you can go back and look at the housing market crash. You can look back at the year 2000 crash, PPP and the pandemic. It all precipitated in much lower interest rates. And that's something that you can't predict. So again, these are things we watch and we try to manage our balance sheet, but they also are other things that other bankers are looking at as they're trying to put out M&A money and going further out on the curve. I think the one thing that is really interesting to me is, what is the 2024 election cycle going to look like? And also, just if we do go into a recession, it's how deep, and will the Fed have the appropriate amount of tools to then put more liquidity in? But I think they're not going to be as aggressive this time, because this inflation that's been baked in, I feel like this is something they're going to hold interest rates up longer than we all anticipated. But from a banking perspective and an M&A perspective, I think we've gone through this once, and I think we're all having to get recalibrated to these new interest rates, which then also affect the multiples on cash flow. So when you're looking at the present value of cash flowing multiples, are these what discount rates that they're using? Is it where it used to be, let's say 3 or 3.5% or 4? Well, now that could be 7. And so again, I think everything's banks have liquidity to lend. It depends on the bank, but the recalibrating of a mindset, I think we're still in that process. But I think by the fall, I think we'll know a lot more. So with that, that's my section, and I'm going to turn it over to John to talk about the M&A and legal considerations.
Hello, everyone. John Farnsworth here. I am a partner at Spencer Fane. We're a national law firm. We have offices that range as far north as Minneapolis, which is where I'm speaking to you today from. As far south is kind of the Houston area. As far east is Tampa, Florida. As far west is Las Vegas, Nevada. So we have a lot of coverage through the middle part of the U.S., St. Louis, Kansas City, Nashville, Dallas, Austin area. So real quick, let's start with a joke, because I'm going to give you a bunch of free legal advice today, and this joke goes with that. So what's the difference between a rhinoceros and a lawyer? The lawyer will charge more. So this is one where you're actually going to get some free legal advice. So stick with me on this. And I know that some of this we've already covered, so we'll actually go through this pretty quickly. But the M&A process from a legal standpoint, depending if you're on the buy or the sell side, really goes through the same life cycle. Now, Mel and Don covered a little bit of this, but I really liken this to kind of like the personal relationship metaphor, where if we're in the marketing phase, or we're kind of in the wooing phase, right? We're trying to date someone. Once we get into that letter of intent stage, that's a non-binding agreement. Some people will call it a term sheet. But to Mel's point, a very important document, we'll get into this a little bit deeper here, covers the major deal points, but that's when you're thinking that you might be a little bit serious. And then once you sign that LOI, that's what we call it, the kind of the engaged time period. And then eventually you're going to work through a closing. We'll call that the marriage. And then the post-closing comes, and that's the real life stage. Honeymoon stage is over. Everyone was very excited to get to closing. Buyers happy because they bought the business. Sellers happy because they got the money in their pocket. But then real life happens, and that's really where your lawyer comes into play. Particularly if you're on the sell side, is that whatever money that you want to get from the transaction, me as your lawyer, I'm trying to keep that in your pocket, okay? Because there's a whole host of things that we'll get into later, that there could be clawbacks, there could be an escrow agreement, there could be holdbacks. You may not get all your money because you have an earnout that hasn't been met. And there could be misrepresentations or indemnification claims where the buyer comes back after the seller and says, hey, I know I paid you this money, but you got to give some of it back to me. All right. So that's the main protection on the sell side. I am shocked at how many businesses try to buy or sell other companies without the help of a lawyer. And it's not just a lawyer, there's other team members, which we'll get to in a second, but the M&A lifecycle, you're gonna see this slide come up a lot during my presentation. You don't have to squint about it right now. We've talked about the lifecycle a little bit, but we can go to the next slide here. And the most key thing is assembling the team. It's not just a lawyer. You've heard from many of those people today. Mel and Don, on their side, as being kind of the broker or investment banker, is a very key essential element to most deals. I would say 80+% of deals are going to have a broker or an investment banker that really helps create that relationship between buyer and seller, okay? Then you're also going to want to have expert accounting and tax advice, particularly if you're on the sell side. You want to net as much as what you can in your pocket. And on the buy side, you want to know if you're going to be spending a whole bunch of money, no matter if you're paying cash out of your pocket, or if you are actually leveraging debt. Say you're going to Todd at Fidelity in Edina, Minnesota, and taking out a big loan, you still can get tax benefits even though you're borrowing money to fund that transaction. You want to have that solid tax advice. Obviously, on the legal side, you'll get into the flavor of some of the value that we may bring to you as a lawyer. I will mention to you that most businesses probably already have a business attorney. But just being simply a business attorney doesn't make you an M&A attorney. So do understand that there is a niche difference between the two. And this is one where I do a lot of M&A transactions. I've actually worked with Mel and Don quite a bit on transactions. I've worked with Todd's bank before on transactions. And just because you have to bring in a more specialized person, don't feel like it's that you're being disloyal to your other professionals that you've utilized. And oftentimes we as your team are still going to be utilizing, if you have a traditional business attorney, for instance, we'll actually be liaising with them on various issues throughout the process. So it's not like they're being shut out of the transaction. In fact, quite to the contrary, we really rely on a lot of their institutional knowledge about the business. The last bullet point here, financial advisor, you mentioned it, you heard it from Todd a little bit, is bankers can be a really great source. They're not going to necessarily give you investment advice. That's not what their role is. But if you're on the buy side and you're asking the bank for a loan, Todd and his team are actually going to give you another set of eyes, frankly, for no additional cost, to basically review the transaction and say, you know what, here's what kind of makes us uneasy. And so it gives you as a prospective purchaser some additional things for you to consider that you may not have. Because the banks can go through their underwriting process. They want to make sure that you succeed as the buyer so that you can actually pay back the loan, right? So there's some other built-in value there. Now, other financial advisors, maybe someone who is giving you stock bond type advice. And those individuals, I think, are also very helpful to bring into the process, particularly if you're on the sell side. understanding what is it, particularly if you are selling your business and you want to ride off into the sunset and retire, what is your nest egg that you need then to preserve to be able to afford the lifestyle that you want to live in retirement? And that financial advisor can run some various different analyses that will be very helpful for you. So on the sell side, there's a lot of different things that you want to consider, such as how do I prepare my business for sale? Now, you mentioned Mel, mentioning that lead time is often years. It's not months, it's years to get your business in shape. And so when we look at some of the factors, it's not just on the legal side, but it's also on the accounting side. How do we make sure that from an accounting perspective, your books and records look squeaky clean, that you don't have a whole bunch of bad accounts receivable sitting out there, that you're collecting things, you've got proper contracts in place. If you've got warranties, if there's warranty problems or any issues like that, you're looking at that. You're looking at HR issues, wage and hour, making sure your employees are classified properly, making sure that if you have independent contractors, that they indeed should be independent contractors and not employees. All these issues create risk for buyers. And as a seller, as much as you can reduce that risk, you're going to enhance what that purchase price is going to be and how much you're going to keep in your pocket. Because a buyer is going to hedge their risk. If you are a risky target, and again, that's the term that we'll use for a potential business that's being sold. If you're a risky target, people aren't going to pay as much for you. Versus if you can show that you're a low risk target, and in some of the ways that you can do that is making sure you have robust contracts. Now, I can appreciate, I've got multiple clients that are in the printing industry, and many of them say, we hate contracts. Our customers hate contracts. They don't like signing contracts. At best, we got purchase agreements, right? We have like purchase orders and things like that. There are ways that you can work on helping protect your business, not just from a contractual liability standpoint, but also enhancing the value of your purchase price. Because if you've got some of those built-in contracts, particularly if they're long-term contracts, even if there isn't mandatory minimum purchase requirements, there are some buyers that will still value that because you've got that business relationship with that particular client that's inked up into a document. Now, that's a little bit more of an intangible thing. If we do have a set revenue stream coming from that contract, buyers even like that better, okay? But those are some of the things that we can actually work on from a legal perspective that may be able to help you. All right, so if we flip to the next slide, you'll see kind of where we're at in the life cycle here. We've skipped over very briefly the first three here, and the little highlighted one in the upper right, the LOI, that's for letter of intent. That's what we're going to talk about next. So on the letter of intent, major deal points, that's things such as how much is going to be paid for the purchase price? Is there going to be an earnout? Are there going to be certain employees that you need to have employment agreements with, and that they are essential to the deal? Because if you don't have them, there's too much brain drain. Or if they're key salespeople, you need to have them maintain that relationship with your existing core client base. Otherwise, the deal just isn't worth the same amount. They'll oftentimes address things such as earnouts, and an earnout is just simply a process where a buyer is not going to pay full price for the business until certain, usually objective metrics are met, such as your revenue is going to be at a certain target level within 6 months or 12 months after closing. What it's trying to do is align incentives between the buyer and the seller about what's good for the buyer is also good for the seller, and we want the seller's help then to achieve that. And you say, well, gosh, if I sell my business, am I really even still part of the business? And the answer is almost always yes. Unless that buyer is purchasing just relationships and contracts, that buyer is going to want you to stick around, usually for a minimum of 6 months, oftentimes 12 months to 36 months. So usually got a 1 to 3 year period. So this goes back to Mel and Don, what they were mentioning about when you're looking to prepare your business. If you know you want to retire in 3 years, this is the immediate time, not just 3 years, 3 to 5 years. This is the time you should be looking at hiring someone like Mel and Don and their team to start getting you in the process of what it's going to look like to get your business in order to sell, because more than likely that buyer of your business is going to want you to work for a period of time. Now, for those of you that have been used to being your own boss for a large part of your life, if not your whole professional life, you're going to find out it's much different versus you being the owner and operator of your business versus being an employee then of the buyer telling you kind of what to do. Now, some buyers are very hands-off. They allow you to operate with autonomy. Other buyers are very much more of the micromanagers, okay? And this is also where lawyers have a lot of value. And again, I'm skipping ahead a little bit here. There's going to be an employment agreement involved, and almost assuredly there will, and there'll be probably some restrictive covenants with that that are going to prevent you from soliciting customers that you've sold basically as part of the business. or competing against the business. And oftentimes there's a tail of 5 years after the close. So if you've got this idea, you're going to sell your business, go on a Mexican vacation for a year and just sit out and kick up your feet and then go right back into competition with who you sold the business to, most buyers are not going to allow that. You're going to have at least a 5-year window within the geographic area and the customers that you're doing business with before you're going to be able to get back into the game, so to speak. Now, most sellers don't want to do that, so it's a non-issue, but you should be aware of that. Going back to the LOI here, though, all these really key important issues, and it's not just the key issues for the buyers, also very key issues for the seller, should be in that LOI. Because what it does then is once we get to that next stage of actually creating the purchase agreement, it's going to greatly reduce, number one, your heartburn and your stress level. But two is it's really going to reduce what your transactional expenses are from a legal perspective, both on the buy and the sell side. Now, 99% of the time, the buyer's legal counsel is going to be the one preparing that purchase agreement. And they are largely going to dictate the kind of the meat and potatoes of what goes in there, subject to what's in the LOI. Now, the LOI, again, is non-binding, but is emotionally binding for most parties, which is it's very difficult to backtrack if someone has set in their mind what the tentative agreement was, and then you're going to try to modify that, very difficult to do so. So one of the pitfalls, and please don't do this, because I've had clients do this before, get your legal review well in advance of finalizing that LOI. If you're in that negotiation process for an LOI, before you, as a seller or a buyer, concretely agree to something to put in that LOI, even if it's non-binding, go get legal review from a specialized M&A attorney, okay? What you'll see that tend to be binding terms in the LOI usually are things such as confidentiality, which is, hey, I'm just not going to go off and parrot to the whole world what we've just talked about here. I'm going to keep this confidential between you and me. Exclusivity is the other real key one, which is from the buyer's perspective, this is a super important thing for them because they are investing a whole bunch of time, effort, money, and money into this process, and they don't want you to go pull out the rug from underneath them if you're the seller and start going and trying to sell your business to someone else. So the LOI, as we talked about this is kind of the engage stage where you want to be really serious that this is a perspective, if you're on the sell side, that this is a buyer that you can see yourself doing business with, okay? So I think we can go to the next slide then. And we see now we're moving down to the more due diligence. Now, we didn't really talk too much about due diligence here, at least on my talk. Mel and Don talked about it a little bit. But the idea here is this is the process to really try to figure out what is the lay of the land. So the buyer's trying to figure out your business as a seller. And from the seller, there's this really common misperception that sellers only have to be there getting information and giving it to the buyer. Quite to the contrary. As a seller, you're going to want to do your due diligence on the buyer. Are these reputable people? Are they sophisticated? Have they done this type of work before? What's been their track record? Have they sued people before in these types of transactions? And most importantly, are they trustworthy people? Because guess what? When you sign a contract, that's just a written, it could be an oral agreement, but generally speaking, it's be a written agreement. It's a written promise that can be broken. And there are far too often times people, and again, these purchase agreements, almost 100% are one-sided in favor of the buyer, okay? Very seldom does a seller get super favorable terms in a purchase agreement, incredibly rare, okay? So when you're on the sell side, this is also where you get your lawyer to help you understand what the reps and warranties are that are going to go into that, okay? Now, the due diligence phase, what usually happens here is the buyer's going to go through and the buyer's going to try to figure out where the skeletons in your closet. Now, on the sell side, if you've done your work properly, if you've hired Mel and Don's team and you've hired a reputable specialized M&A counsel, they're going to help you clean house and hopefully minimize what skeletons are in the closet that the buyer may ever find, okay? Because you're going to work that stuff out ahead of time. And if there are skeletons, you want to be very transparent about that with the buyer. And ultimately, that will come out in the due diligence process. Again, the due diligence process, the buyers are going to send over a whole ton of different questions for information. And you as a seller are going to very quickly figure out how much it really stinks as part of this process and how tedious it is, how time consuming it is, and what all the buyers are demanding. So oftentimes it's not unheard of if you're the seller of a business that you will get kind of your right-hand person to take the leading oar and laboring oar on this task. Obviously, they have to come under the cone of silence to know that there's a possible sales transaction occurring. So some owners say, you know what, I don't want to tell my staff about this until I'm very comfortable that I am selling, so I'm going to have to own this process. But some of the things that come up during the due diligence process, you can see on the screen here. I don't need to go over those. But some of the real big ones that I'm seeing in your industry that you should pay very close attention to, just given, and we've seen this, and hopefully the worst of it's subsided, but the issue of supply chain pinches and pricing increases. Okay. Now, a number of my clients in the printing industry used to give price quotes that were valid for about 30 days. At least a couple of my clients are now only offering price quotes that are valid for basically the same day or within a matter of hours. So they want to have spot pricing. Once you lock in this agreement, I'm going to tell you what the price is. I can confirm the price. So if you are going to enter into contracts where you've given out guaranteed pricing to clients, that is a major risk factor for you that a buyer is probably not going to like a whole lot, given that we're in a highly inflationary environment. But all those issues come up in due diligence. So the deep dive is the whole process of understanding what all is happening. So here you see the next area where we're at in the life cycle. Your additional price negotiation. It's not uncommon, depending on what buyer you're dealing with, for them to try to come back to the well, so to speak, and say, hey, I found out all this stuff during the due diligence process, which I didn't know about previously, and it makes me reconsider how much I want to pay for your business. So don't be surprised if that occurs. And that's, again, where you can lean on your team members, such as Dawn and Mel, and your lawyer to help protect you on that side. And this also, depending on how and what gets disclosed early on, kind of through the LOI process, can help reduce the risk of this. But generally speaking, this is a situation where the buyer somehow doesn't believe the business is as profitable as what they previously thought. So with that additional price modification, it's not always a guarantee that that's going to occur. We go into the next portion of life cycle, and so you can flip there to the next slide. And you'll see that we're in the financing phase. So if you're on the buy side, this is where you're going to want to, at the very least, probably want to give Todd and his team a heads up well in advance of this, that you're thinking about buying a company, understanding kind of what the costs and expenses are from the interest perspective. In Q1 of this year, I had 90% of my M&A deals blow up because interest rates exploded so quickly that the cost to the buyer, and these were sell side deals, the cost to the buyer was astronomically higher. They just couldn't afford it anymore. So the deals blew up because, yes, there was LOIs in place. Yes, there was dollars affixed to this is what the purchase price is going to be. But that buyer no longer could afford that debt service because guess what? Instead of interest at 5.5%, they were looking at interest rates, at least 1% or more higher. So for them, that really modified the deal. If you're on the buyer side, you want to make sure you're speaking with your banker, understanding what can you afford. What's that pricing going to be? Is this, what are the terms in terms of it? Is it locked in? Is it not locked in? Most of the bankers aren't going to give you sort of locked in pricing unless you're signing on the dotted line. You're actually making a commitment. But that's, again, where Todd and his team are going to be really vital for you. Things you're going to want to consider is, depending on the size of the deal, the complexity of the deal, making sure you've got a good banking team. And luckily, Todd and his team have fabulous resources. They are some of the best bankers that I've worked with professionally. He's not paying me to say this, but they are good people. They tend to be very diligent in terms of their underwriting process, depending on your risk tolerance as a buyer. That can be good or bad for you. But again, you prefer to have a banker being your second set of eyes and ears to make sure that you understand what those risk factors are. Depending on the deal size, some lenders might not be big enough for you. If you need so much money, a particular lender may not be able to give you all that money. So they either need to go out and find other banks for you to work with, or they may just say altogether, we can partner with you with some of these other banks participating, or you have to go out and find a different bank altogether. But all the more reason just to chat with your banker ahead of time. Next slide is moving now into the purchasing. Finance side. Sorry about that. So this is where I talk about the financial advisor. And on the sell side, I'm shocked at how, now people don't pay me to be a financial advisor. Yes, I have an MBA, but I don't do financial advising, okay? But if you're a seller, and let's say you're going to get a $10 million lump sum at closing, and assuming that money can earn 5% interest right now, every single day that you delay putting that money to work in the market is cost you almost $1,400 a day. Now, this is some pretty crude math, and yes, I'm sure Todd and his team probably can poke some holes in this a little bit. But the idea here is time is money. Okay, so if you're on the sell side, and I'm not saying that you should be counting your chicks before they hatch type thing, but you want to know when that money comes in on the closing date, where is that money going? And depending on the size of the transaction, you obviously have issues about FDIC insurance, making sure that you've got your funds diversified. what accounts of the money where the money going to be wired into, and usually that's the business company account. And then how is that going to be dispersed out to the owners? You want that process to work seamlessly and relatively quickly, because there's also then legal risk there. The longer you keep that money in the account of the business, what happens if there's liability for the business? Now, if you give yourself a legitimate distribution, you're kicking that money out of the business. The business then doesn't have the assets then to pay other liabilities. Now, I'm not suggesting, and there are people that do this and do not do this. If you are aware of liabilities associated with the company, you can't just flush out all the money out of the bank account from the company. Say, hey, the company's got no more money here. I've just taken it personally. That's not going to fly. That would be deemed a fraudulent transaction and get you in a whole lot more hot water. But nonetheless, if you don't know of any liabilities, it's better than to flush that money out sooner rather than leaving it there, usually. All right, next slide. We're moving into the purchase agreement. So this is the LOI on steroids. Again, buyer's counsel is usually the one that drafts this. This is going to include exhaustive representations and warranties, some of which that the seller won't even know, despite running their business, say, for the last 3 decades, that the information is even true or not. And so the buyer's asking very aggressive things that are going to make you as a seller agree that these things are truthful. And if they prove not to be truthful, then the buyer's going to come and hold out their hand and say, pay me some more money. I either, if I've got an escrow, I'm going to grab the money from the escrow account. If I've got a holdback, I just take the money. I don't give it to you. If there is money that I have an indemnity clause, I can go back to and actually say, okay, pay me $1 million, and if you don't pay me, I'm going to sue you. And then the provisions in the agreement, again, these are all subject to negotiation, and there are some general standards, but there's also a whole lot of gray area involved too. This is where your lawyer on the sell side is worth their weight in gold. Whatever you're paying them, this is really the meat and potatoes of what they need to do, other than the general advising in the front end with the LOI, reviewing that for you to make sure you're not stepping in landmines. The purchase agreement, and particularly on the reps and warranties and the indemnity clauses, are the real key areas of risk. Ultimately, the purchase agreement is also going to set the landscape for what happens, how to get to closing. There will be some preconditions to closing, such as, hey, the buyer has to be able to have done all their due diligence. Maybe there are some licenses, permits, or contracts that have to be assigned from the seller to the buyer, and those need to occur first before closing is going to happen. It could be situations where employment agreements need to get signed by employees. It could be situations where the buyer wants to terminate your employee benefits. And by the way, this is where, despite being an M&A attorney, I don't even dabble in that stuff with employee benefit plans and things like that. We bring in the experts. So while we as an attorney will generally head up this whole process between start to finish and buying and selling companies, we also bring in other specialized team members, and an employee benefits attorney is one of the key areas where if your attorney thinks that you're a one-person shop and are doing 100% of it, you don't have the right person. Flat out, you don't have the right person. So it's not uncommon. Some of the transactions I'm working on right now have, I would say, a range of about 5 different attorneys. We usually have a specialized real estate attorney, an environmental attorney if there's real estate being sold. We have an HR benefits person. We oftentimes will have an employment attorney to review employment agreements, which is slightly different than the employee benefits side. If litigation issues are at stake, we may have a litigator come in and give us some advice. If there's real specialized IP issues, now I do a fair amount of that, but I'm not a patent guy. So if there's patent issues, we bring in a patent attorney to review that. Trademark and copyright, I do have the ability to handle that myself because I do a lot of that work. But as you can get a flavor, there's also a team of legal people. It's not just one person. But all that happens through that process of the purchase agreement. Start to finish purchase agreement, bank on it taking about 3 months, okay? Can it go quicker than that? Yes. Can it go longer than that? Absolutely. But that's, I would say, about average. Next phase here, RWI, that's reps and warranty insurance. And oftentimes this is a newer product that people are looking at. If the seller does not want to hold that risk of having to possibly pay the buyer, and the buyer doesn't want to have the risk of trying to track down the seller, sometimes the buyer and seller will get together and say, hey, if we purchase this insurance product, then it can help reduce both of our risk. And are you willing to help split that cost with me? Now, generally speaking, a buyer, if the seller does not agree to split the cost, then the buyer is going to cover that expense. And the expenses on RWI insurance can be very expensive. The benefit on RWI policies, they actually get their own legal counsel involved, who also then reviews the purchase agreement. And for you as a buyer, it actually arguably helps you because then you have a second set of eyes from a legal perspective on the purchase agreement, also asking various questions. Okay, well, maybe you need to push back harder on this, or why do you have this? The premiums can be expensive, about 2 to 6% of the coverage provided. Most RWI policies I generally don't see issued for transactions that are less than about 20 million. So you have to have a sizable transaction for this. You're not obligated to, but most of the RWI insurers prefer the higher, bigger dollar transactions for how much work they have to put into it. It's just not as cost effective with the premiums. Keep in mind that regardless of if you get insurance or not, you can't be making misrepresentations knowingly as a seller. So that's not going to protect you. But this is something that more and more transactions are looking at. So next slide. All right, more due diligence. You can get the flavor here. Due diligence never is done until you get to closing, okay? So throughout the process of the transaction being negotiated, you still have to run a business if you're on the sell side. Well, the buyer wants to know how you're running the business. Oftentimes is going to ask for some updated financials. They may be asking you what new clients have come on board. They may not want you to sign contracts with new people without their permission, things like that. So all these things eventually go into the schedules, which are exhaustive as part of the purchase agreement. It's not uncommon for purchase agreements to be well over 100 pages between the 30 or so pages of the purchase agreement itself, plus schedules, which can be hundreds of pages. And the schedules will include itemizations on what are the exceptions to some of the reps and warranties being made. For instance, if a rep and warranty says, we have no pending litigation against us except what we have listed in the Schedule 1.1. Schedule 1.1 then would list the lawsuits that were pending. All right, next slide. All right, closing, hooray, we're there. All right, money exchanges hands. There should be a settlement statement. Oftentimes, if you're working with a banker or a broker, they're going to be heavily involved in making sure that they like how that settlement statement looks. Obviously, get check off from your attorney as well. And then there's a payment of cost. So let's briefly talk about that because I know we're running short on time. So next slide. Sell side costs, depending on the size of the deal, most of the time a broker or investment banker are going to ask for some retainer payment up front. Now, this is something where if you were to ask me 5 years ago, I would say that most of the bankers or brokers were willing to really work and negotiate more with you on having reduced fees up front. There's hardly a broker or investment banker that I'm aware of right now that won't demand some retainer up front. And those fees can vary greatly. Some brokers or investment bankers are going to want to have a monthly fee. Maybe it gets capped at a certain amount. This is all negotiable. So this is another area. Involve your lawyer in this negotiation on reviewing the engagement letter from your broker investment banker before you sign them up. I am shocked. Look at the differences in success fees from 2 to 15%. Now, a lot of that is based on the deal size. Okay, the bigger deals have a lower success fee. And when I say success fee, that means just at closing. In addition to whatever you've paid on a retainer, you're also going to be paying a percentage of that sale price. And but this is subject to negotiation up front. Some brokers and investment bankers will negotiate, others won't as much. But this can save you a ton of money. It can pay for your legal fees just doing this process alone. All right, next slide. Accounting and tax fees. Again, the accounting people are worth their weight in gold on what they usually save you in taxes. Expenses, generally what I see is somewhere between 15,000 to 150,000. Again, huge range. It just depends on how much heavy lifting there is there. If there's going to be a quality of earnings done, that's pretty expensive. There usually becomes some debate about who pays for that on this, and that's also something that your broker like Mel and Dawn talk about that with their clients all the time. On the legal side, if it's a smaller deal, you can budget usually about 25 grand. Larger deals, and again, it's not to say that there aren't plenty of larger deals beyond this, but somewhere between 25 grand to 500 grand. And you say, well, that's a huge range, John. Again, if this is a situation where you say, hey, I'm going to sell my business and it's going to be for $5 million, obviously we're not going to do the same amount of work, even though there's usually about the same amount of work to be done in a $5 million transaction versus a $50 million transaction. But there are some corners that get cut, and we will work with you and advise you, not just on the legal costs of how we will propose and try to keep your costs down, but also on the accounting side. Next slide. The accounting, tax, legal tend to be higher on the buyer side than on the seller side. Usually that's where the bulk of the work is going down. It's not uncommon for me to see the buyer's legal fees at between 2 to 3 times what the seller's fees are. Now, again, I can sit and armchair quarterback some of that. And then in areas where I don't see that the buyer's legal fees are that high, usually it's because they're not putting in enough work or their client won't allow them to do the work that they should be. Broker investment banker fees are payable at close, separate from the retainer. And again, that's a situation where that's all subject to negotiation up front as part of that engagement letter. That will be set in stone usually, and it will be a percentage usually of a comprehensive valuation of the company. Keep in mind, even if you only sell 51% of your company, your broker investment banker usually is going to want to still have the valuation done on your entire business. Even though you're keeping 49% of it, they're going to view, and that's one of the pitfalls that you're going to want to be aware of. Some brokers, investment bankers are very transparent about that. It's shocking to me how many of them try to kind of hide that from owners. Lending costs from bank are what they are. You have a loan and origination fee and interest. Bankers are incredibly transparent about what their fees are going to be. They don't have the ability to really hide those fees based on applicable law. So you generally can trust that process from a banker. All right, so you've seen the whole life cycle here. Last issue is post-closing. We've talked about it a little bit. There's holdbacks, which is, hey, if the purchase price is 10 million, I'm going to hold on to $1 million of it for 6 to 12 months after closing until I know everything's okay. Then I'll pay you that. Escrow accounts are a little bit of a hybrid, which instead of holding the money back personally by the buyer, it actually goes to an escrow agent. And there's indemnity claims, right, where money necessarily has exchanged hands from the buyer to the seller. Seller then would be obligated and liable to pay back to buyer certain amounts. As a seller, you never, ever want to be in a situation where you're somehow giving the buyer more money than what they gave you. And it is shocking to me. I've had a couple situations in my career where inadequate legal support on the side of one of my clients, I was not part of the transaction, where they actually accept more liability than even the money that they got from the closing, which again is a bit shocking. You don't want to do that. Then there's also obviously litigation that can come up after closing. That's not uncommon, honestly, particularly with employment issues where there can be just some disgruntled employees that are no longer happy, want to leave, and then raise issues. And then the default is if it's post-closing liabilities, usually the buyer's obligated to pay for those. If the liabilities sprung up from something that happened pre-closing, then usually it's the seller that's responsible. So with that, we can open up for questions. Thank you for bearing with us. I know that was a lot of content to get through.
Great information. Thanks, John. The numbers that you shared are really, really impressive, just on the breakdown of what they can expect from fees for each part of the process. Could you generalize and say from a percentage that a deal costs the buyer in general a certain percentage and the seller a certain percentage of the value of the business?
Yeah, good question. So the buyer oftentimes is in pretty good control of what they want to do on their side, and they can tell their professionals, do this work or don't do this work. Because the success fees from the brokers and investment bankers are paid by the seller, the buyers usually don't have to worry too much about that unless they've hired their own broker or investment banker to assist them. Okay, so the buyer, they have a lot more power and control of the fees. On the sell side, generally speaking, we wouldn't want to see your transactional fees more than 10% of the transaction. We want to see it south of that number. And there are some ways, on the legal side, some lawyers are willing to reduce their hourly fees for you while saying, if you want to pay me some portion of the success fee on closing, that way, if the deal blows up, you don't have to pay me as much. And so it's kind of sharing risk. There is a bit of that. But ultimately, I think there is I'm shocked at how many of my clients simply say, oh, because I know it's going to cost me $100,000 to do this transaction, I'm just going to cut out the accountants and the lawyers, and I'm going to do this deal directly because it's going to save me $100,000. Every single time I've seen this happen, you as the buyer in that situation are assuming way more liability, like usually exponentially higher liability. So if you're concerned on fees, that's a talk have up front with your working professionals and your team. And generally speaking, we all still want to have jobs unless we're providing value. And so that's something too, where you want to hire people you trust. Now, could you be overbilled? Yes. And frankly, I do see it, not to pick on the bankers, and Mel and Don, their team is fabulous. I've never once seen them mistreat a client, which is also why I refer them a lot of business. But there are plenty of brokers and investment bankers that I see that fundamentally, in my opinion, take advantage of sellers on the sell side that just simply don't know kind of the Wall Street talk, and also don't understand kind of what the industry norms are. That, as a lawyer, our number, despite all the lawyer jokes out there, we have a fiduciary duty to our clients. So we have to tell you the advice that is best for you, not what we would do personally necessarily, not in our self-interest, but what's best for you. And so that's where, initially we'll get involved in that discussion with your broker up front on that engagement process. And so we're actually arguably adversarial at that point, but then that very much switches into we're team members after that. So, there's a bit more of an art than a science in how to negotiate that. But Teresa, to your point on the cost side, that's one really explore it up front. And the idea is that on the sell side, you want to net as much as possible. And that's really where we can speak with clients in the front end to say, okay, here's what we think your net's going to be. And we bring in the financial advisor to make sure that they give full comfort to the sellers, saying, okay, you're actually going to have enough to live the life that you want to live in retirement.
Excellent. Are there other questions from the group? I know we're about 7 minutes over our allotted time, but such good information. We still have 35 participants on the call. Now is the time to type in any specific questions. And while we wait a minute to see if someone does, I'm going to ask Ken to step in, see if there's any last details he wants to add.
No, that there's overwhelming the amount of thought that goes into this. And, it does sound like you do need professional help if you plan on selling a business here, or on the other side, buying a business. And, you hear of these deals that go so fast, and that's when it seems like a lot of things go wrong or misrepresentations happen. And yeah, it can be dangerous. So very interesting content. And I know we spoke in generalities, but, everybody's contact information are on the slides, and Ben is going to post those up to the websites. And if you have any questions, I believe that everyone would be real fast in answering your question, or at least directing you in the right direction on how to proceed if this is something you want to pursue going forward.
Another thing I should have mentioned, Ken, which I didn't, is there's really two primary ways to structure these transactions. One is to purchase the assets, and the other is to purchase the actual equity or the stock in a company. That has fundamentally huge ramifications on the buy and sell side. And you're going to want to be aware of how to structure that transaction from the get-go at the LOI stage, if at all possible.
Yeah. So if there's no other questions, Teresa, I think we'll just wrap up. And I want to say thank you to our 4 presenters. You provided us with lots of information. And for those still on, please keep in touch with us and check for the next round of our Financial Executives Committee. We should be coming up in September for our next presentation.
Thanks, Ken. That was terrific. One last plug, and that is the wage and benefit survey is coming out next week. So look for that and encourage your teams to participate. With that said, we will end it here and send the recording and PDF of the slides in the coming days. Mel, Dawn, any of the rest of the committee have anything you'd like to add?
No, thank you for having us.
All right.
Yeah, thank you.
Have a great day, everybody.
Thank you, everyone.
Bye-bye.
Thank you.